Hello folks, welcome to accountinglecture.com. Today's topic is schedule of non-current asset. Schedule is movement and non-current assets are your fixed assets. So what movement? If it is an old business, they must have some non-current assets from previous years and a year before. Then they might buy some assets this particular year. They might sell some assets. There could be a bit of revaluation of land because land value goes every year up. That's all things we can see today. Okay, let me quickly draw a pro forma. There's a set pro forma of doing it. Let's assume any business, the business has three particular assets: land and building, plant and machinery, fixtures and fittings. These are our three columns. And the row, want to start with any balance of the assets they had from previous years. We call it balance BD. You can call it start at the beginning. Whatever is the balance, you write down here the figures. Plus addition, purchase of non-current asset. Anywhere you can write it down, even if you purchase here. Less disposal, if there is any. There could be like no disposal land and building, could be disposal in plant and machinery, or could not be. Let's assume none disposal over here. And if there is any revaluation of your land from previous figure, it gone up, you need to add it. Especially it happens with the land, not with the other stuff. And that's it. You do total. I'd rather say this total is your closing balance. Balance CD. From top, you worked out this bottom. That's the end. And this is all of it is your cost. The structure of your cost. Now we have to deal with depreciation. Let's put some figures in it from one of the examples. I have a set example, and there we go, the example at the bottom. Here is the example. Take the highlighter. The directors of Goodwin PLC provide the following balance sheet: 30th June 2003, very old balance sheet. Okay, so property, plant and equipment is the heading, but you are given 1, 2, 3 information of assets: land and building, plant and machinery, fixtures and fittings. Cost, these are all opening: 200,000, 75,000, 50,000. We'll take it into our pro forma. Depreciation, I said we will deal with this depreciation in a minute later. Once we deal with the cost part, then there will be depreciation part, and you get net book value. Once you take away from cost, you get net book value. Let's read a bit more information. During the year ended 30th June 2004, see, 2004 at the end. 2003 was the start, 2004 is the end. Following transactions took place. Okay, land and building revalued at 260,000. From 200, it become 260,000, 60 up. Plant and machinery was purchased at a cost of 25,000. We'll add it. Fixtures and fittings purchased on 2001. Wait a minute. 2004 now, 2001. So 1 to 2, 2 to 3, 3 to 4, 3 years matter. 3 years before, we bought it for 10,000. Now we are selling for 6,000. Students very often get confused. 6,000, 10,000, which figure shall I take? You take 10,000, you deduct it from the cost because that's the cost. You bought it 3 years before. Now by selling it, you're getting 6,000. Whether it's a profit or loss is the other story. We'll take into the income statement, not needed for the schedule of non-current asset. Okay, now fixtures and fittings were purchased. More purchase for fixtures and fitting, 15,000. All this information valid, easy stuff. We have a set pro forma. We'll take it into account right here, right now. Okay, Let me take my eraser very quickly and delete this information like XX, and we'll put some real figures inside. Okay, so if you remember, we started with land and building 200,000, plant and machinery we have a figure of 75,000, and fixtures and fittings 50,000. This is the balance BD information we have taken from these three. Then the first one here said revalued to 60,000. Let's quickly check and take it. We haven't seen any addition of land and building, no disposal, revaluation to 260,000. So 60,000 is up and 260,000 is the closing value for your land and building. Plant and machinery and fixtures and fittings, there are some purchases and disposals. Let's quickly check it. Plant and machinery was purchased at a cost of 25,000. Rest is fixtures and fittings. Purchased was disposed 10,000 minus, and purchased during the year 15,000. So let's go to the plant and machinery. 25,000 purchase. Yep, there we go. Addition is the column. 25,000. And yes, we bought some fixtures and fittings out of 15,000. And there's no disposal of plant and machinery, but we bought an asset 3 years before for 10,000. That's been disposed now. That's the value, should be taken away. And there is no revaluation of your plant and machinery, fixtures and fittings. Boom. You just add up. Easy addition. 100,000. 50 plus 15, 55 minus 65 minus 10, 55,000. That's your closing balance for non-current asset. That's the cost part we dealt with, the movement. Now, the interesting part is the depreciation. Rather, it's a provision for depreciation. Okay, let's draw a quick pro forma and let's solve the question. And the pro forma pretty much looks like this. The one we did it at the top for assets. Depreciation. That's the second part of your schedule of non-current asset. Okay, we had three assets. Land and building. Plant and machine, fixtures and fittings. We could have followed the top one like this 3 column. Yeah, we could have followed it. Okay, no problem. Making something new is good. Okay, plant and machine. All right. To gain money signs are here. Okay, the pro forma is, yes, we start with the balance of our depreciation, provision for depreciation, if there is any. If it is an old business, obviously there should be some. So balance BD, or you can say start at the beginning. We start plus charge for the year. Now this charge you might have to work out. Less elimination on disposal. There could be a working here. Remember one of the assets, fixtures and fittings, out of 10,000 we bought some 3 years back. We sold it now in 2004. Year ends are very important. Well, that should be taken away. So that was, I remember over here, should be minus from fixtures and fittings. We have to work it out. And the last rule is elimination on revaluation. Well, if you revalue your non-current asset, any old provision for depreciations, any balance should be zero. Why? Because the asset's value gone up, there should be no depreciation left over. So yes, we have whatever is the balance over here, the same balance should be taken away. These two figures should be 0, and that's it. You do total, that should be your balance CD, or the end value of your depreciation. That's the provision for depreciation closing one. Okay, once you deduct it from the cost, you get net book value. All right, let's put some figures. Let's scrutinize our example. Going bottom, I want to clean this board with my eraser. Okay, then it doesn't take much. Good technology, good use of it. Okay, the first part you have done, which is cost. Now, Goodwin PLC's depreciation policy is as follows. All right, land and building are depreciated using straight line method, 2%. So straight line on cost straight away. So if you remember, land and building, this is our working one. We had a closing cost of 260,000 because it said here it's gone up. So yeah, 260,000 proper 0 times by 2%. Get the calculator, and the answer is 5200. Okay, plant and machinery. Now second one, W2, plant and machinery depreciated using reducing balance method, 25%. You remember, if it is reducing balance, you don't charge on cost, rather you look for net book value, you charge on it. Okay, so we look for the net book value of our plant and machinery. Okay, there we go. The plant and machinery, 75,000 minus 35,800. You're left with 39,200. But you remember you bought some of the plant and machinery over here, 25,000 plus 25,000. So the value is 64,200. See, my big calculator is helping me all my accounting studies and teaching profession. Well, okay, it's we got a net book value. You do 25% of a, and you get that's my calculator, what it says, 25% of 64,200, 25%, you get 16,050. Okay, that's over here, 16,050, working number 2. All right, moving on to fixtures and fittings, depreciated 15% per annum on cost. Okay, on cost means a straight line, but let's read one more line here. It says non-current assets are depreciated for the whole year in the year of purchase, but are not depreciated during the year of disposal. What do you mean by that? Irrespective of whatever month you bought it, whether you bought the beginning of the month or at the end of the year or month, the year you bought it, you charge the full year's depreciation, no pro rata, no month by month basis. But the year you are selling it, you can't charge depreciation. That's the rule they are telling us. Okay, no problem, we'll follow it. Just check it. When did you buy fixtures and fittings? You bought July 2001. Okay, so working number 3, fixtures and fittings. 2001 to 2002, it makes 1 year. 2002 to 2003, it makes 2 year, year 2. 2003 to 2004. 4 is our year. Have a look at the bottom. Yep, there you go. 4, 3 year. So over the 3 years, but our rule is you can't charge last year's depreciation. So over the 2 years depreciation, you need to charge. What we are calculating is we bought an asset in 2001, and that time it bought it for 10,000, and they said charge 15% on it. Charge 15%, you get 1,500, and again 1 to 2, 2 to 3. If you do the same thing, it's straight line every year is same, it's 1,500, and 3 to 4 is 1,500 again, but you don't take last year's depreciations. Over the 2 years depreciation is 3,000. So provision for depreciation on 10,000 is 3,000 provision. 10,000 is the cost. Over the 2 years depreciation you need to take is 3,000. That's the elimination on your depreciation. We'll take into account straight down. Okay. Oh, we haven't started. We're just doing the workings. No problem. We'll take it one more small working. Working number 3, we can put it in. It's 15% on the asset we bought, the cost of your fixtures and fittings. Just keep checking. The cost of our fixtures and fittings is 55,000. You can do 15% on it, and you get 8,250. That was our last working. Let's keep putting the items in it. Okay, depreciation. Let's quickly take my eraser and yep, just erasing the items. All right. So at the start, what are the items of your depreciation? Land and building is 55,000, and plant and machinery 35,800, and the other one is 12,400 fixtures and fittings. We will take this information at the beginning of our balance as balance BD. So 55,000 and 35,800 and 12,400. Okay, well, I think in charge workings we have done for the charge. There's none for land and build. No, there is land and building. 5,000 something. Just quick check. Yeah, there you go. 5,200. Okay, 5,200 for our land and building, and plant and machinery got some 16,000. I remember, just double checking. Yeah, 16,050. 16,050, and the other one 8,250. We just did at the top. There we go. Here, straight on your cost, 15%. Okay. And the elimination and disposal, there is no disposal for land and building, plant and machinery, but if you remember, we had elimination on disposal for our fixtures and fittings, and we calculated it's 3,000 just over here. We've done quite a few work for this elimination on disposal to get our desired answer. 3,000. That should be taken away. Yes, we did it. And elimination and revaluation, which is exactly 55,000. There should be no previous depreciation. That should be taken away as well. Okay, so let's take my calculator and calculate it. This is easy peasy stuff. 5,200 should be 35,800 plus 16,050. You are left with 51,850. 12,400 plus 8,250 minus 3,000. You're left with 17,650. That's your provision for depreciation, the closing one. Now, you remember we did our costs over here. Yes, these are the costs. From the cost, you deduct this provision for depreciation. Less provision for depreciation, you'll get net book value, and that's how you do schedule of non-current asset. If you like the video, please share it with your friends. All the best.